All right, so at this point, you should be aware that there is such a thing as fiscal policy and such a thing as monetary policy. That fiscal policy is controlled by the president and Congress and has to do with government spending and taxation, and that monetary policy has to do with the money supply and the interest rate. But the question is, changing taxing and spending levels, we know how that works to an extent, right? Congress and the president do that through bills, through laws. But how does the money supply get changed? Well, it typically doesn't get changed by actually printing money, contrary to what a lot of people think. And this is what I'm going to talk about today. How does that process actually work? I should start by saying that just like with fiscal policy, in monetary policy, there's an expansionary policy and a contractionary policy. Okay, expansionary policies are designed to boost GDP, whereas contractionary policies are designed to restrain GDP growth, but really the purpose, again, is to halt inflation, because inflation tends to happen when the economy is growing, not when the economy is shrinking. Now, really, just like with fiscal policy, with monetary policy, it's about changing aggregate demand. Okay, so when aggregate demand goes up, GDP will and the price level will go up as well. And when aggregate demand goes down, GDP will go down and the price level will go down as well. But really what we're trying to do is change the spending level, because if spending goes up, that means aggregate demand is going up. People are buying more. And if spending levels go down, that means aggregate demand goes down. And we still have this Keynesian idea that a downturn generally is caused by a decrease in aggregate demand. And if we want to start a recovery, if we want to get back to where we were before, we're going to have to boost aggregate demand, boost spending levels back to where they were before, not only for consumers and households, but for businesses too. Now, in fiscal policy, we call these expansionary and contractionary, and we're still going to do that with monetary policy, but there are other names for them as well. When we're talking about monetary policy, policies that are designed to expand the money supply are generally known as easy money policies, whereas policies that are designed to contract the money supply are known as tight money policies. And easy money policies are pretty much expansionary, okay, making it to get money, lowering interest rates. Those are expansionary policies. Tightening the money supply, having a tight money policy, is generally going to be contractionary. It's going to decrease spending levels. So you'll remember, hopefully, from the last video that the way the Federal Reserve can change the money supply is not generally by changing the monetary base, not by altering the actual physical amount of dollars that are out there, but by changing the money multiplier. In other words, making it so more lending happens, because that's how that monetary base is multiplied up into what is really the money supply, by lending more money, by lending a higher percentage of their money, or lending less. And then that, in turn, will affect interest rates. So the more money is out there, okay, the greater the money supply is, the lower the equilibrium price, or the equilibrium interest rate, is going to be. And the smaller the money supply is, the higher that equilibrium price, or the equilibrium interest rate, is going to be. And you can go back to your supply and demand graphs, okay, your supply and demand curves, for that, because it applies to money just like it applies to any other product. Now, it's relatively obvious why increasing the money supply would be expansionary. If there's more money floating around out there, at least until the inflation hits, people feel richer and they're going to spend more of their money, both consumers and businesses. But why should a change in the interest rates be expansionary or contractionary? Well, consumers are more likely to spend money when interest rates are low, because that's when you want to buy some big ticket items like a car or a house, or even something like a boat, or a cottage up north. So when interest rates are low, those things are more likely to happen. That means there's more jobs in construction, in the auto industry, and that's expansionary. But when the interest rate is higher, then that's when you kind of maybe avoid buying a new house, or stick with the old one, or avoid buying a new car and make the old one run a little bit longer. So that means that jobs that there could have been in the auto industry or in the construction industry, that didn't happen because you didn't want to buy or build a new house. But the interest rate is going to affect businesses as well, and business investment. Okay, and you can kind of think of it this way. Any business has a range of potential investment project possibilities, okay? And they're going to rate those possibilities based on their expected return on that investment. But most companies don't just have money to throw around. Maybe they do, and that's not going to be affected by a change in the interest rate because they wouldn't have had to borrow the money. But most businesses, or a lot of businesses, are borrowing money in order to do new projects. So if you have to borrow money at 8%, if that's the market interest rate, then you're not going to do a project that you expect to earn less than 8% on. at all, right? You're just not going to totally skip it, because what would be the point? You're going to actually lose money. So, it's not that when the interest rate goes up that businesses will completely stop investing. It's just that they're going to restrict their projects to things that they expect to get a relatively higher rate of return on. Remember, all these things are at the margins. So if the interest rate goes from, say, 7% to 6%, suddenly a whole range of investment projects that will earn from 6 to 7% become viable that were not viable or profitable before. So decreasing the interest rate makes businesses more likely to invest in new projects, creating jobs, creating economic prosperity. So lowering the interest rate is expansionary. Raising the interest rate will make businesses less likely to want to start new projects, and that's going to be contractionary. So how does the Federal Reserve actually influence the money supply and interest rates? Well, there are three ways that I'm going to talk about. The first is changing the required reserve ratio. The second is changing some of the interest rates that it controls, like the federal funds rate or the discount rate. And the third one is open market operations. Now, the required reserve ratio is the regulation that the Federal Reserve Bank uses to make sure that banks are holding on to what they consider to be enough of their depositors' deposits. So that the system won't be so risky, because if the bank is lending out 99% of the money you put in there, that could be a big risk, right? You might try to get some of that money out, and then there will be a bank run, and then, that would be bad. So they do actually make the banks hold on to a certain amount of their reserves, and that's the required reserve ratio. But if that required reserve ratio is quite high, that means banks can lend out less money. And if they're lending out less money, that's less money multiplication, which you'll remember from the last video. So if you raise the required reserve ratio, you're reducing the amount of money that banks can lend, which means you're reducing the money supply. Okay, so if you do the opposite, if you lower the required reserve ratio, you're going to increase the money supply, because suddenly banks can lend out money that they couldn't lend out before legally, and so they're going to create more money by lending more money. Hopefully you'll remember, too, that part of the original purpose of the Federal Reserve Bank was to be a lender of last resort to banks that were in some kind of emergency. Okay, so that is one of the functions of the Federal Reserve still. They lend money to banks that need some money. But they try not to do that as much as they can. Instead, they try to have banks lend to each other if there's an emergency. And they actually set the interest rates at which those things happen. So those are not determined by supply and demand. Those are determined by the Federal Open Market Committee of the Federal Reserve Bank. So the interest rate at which banks borrow from the Federal Reserve is called the discount rate. And the interest rate at which they borrow from other banks that are part of the Federal Reserve is called the federal funds rate. All right. So if they raise those interest rates, that means that banks are less able to borrow money because the price is suddenly higher. They're less able to borrow money in case of an emergency or just to tide them over for an evening from other banks or from the Federal Reserve Bank itself. If they're less able to borrow that money, they're less willing to lend money themselves. And if they're lending less money, that means that the money supply is going to shrink, because we know that so much of the money supply is created through lending, through that money multiplication process. And if the Federal Reserve decides to lower the interest rates, lower the federal funds rate, lower the discount rate, that means that it's a little easier for banks to get money. So they're more likely to lend money themselves because they have a little bit more access to extra funds. So that means that money multiplication will increase and the money supply will increase. Of the three methods, the one that is most used by far, however, is open market operations. And the reason is that open market operations are much more flexible than the other two. If you change the required reserve ratio, that would force banks to make potentially very large changes. For example, raising the required reserve ratio by 10% might require banks to call in millions of dollars of loans, which would be very, very difficult. And changing interest rates, those changes would take a while potentially to change anything in the system. So the open market operations are really what they tend to do the most. Now, what open market operations is this. Basically, it's the Federal Open Market Committee and the Federal Reserve itself purchasing or selling government bonds, government securities on the open market, either buying them from bond dealers or selling them to bond dealers. If the Federal Reserve decides to sell some government bonds on the open market, what this means is that they contact some bond dealers and make a deal to sell some of these bonds. And now, when that happens, what really is happening is that money is coming out of the economy, out of the hands of bond dealers, into the Federal Reserve. So that's contractionary. Okay, they're actually taking money out of the economy and just sort of sidelining it for a while. Whereas if they buy government bonds, government securities, they're paying for those bonds in cash, in money. So they pay bond dealers. That money goes to the bond dealers out into the economy, out of the Federal Reserve Bank, and the Federal Reserve gets government securities in exchange. So that's expansionary because money is actually coming out from the sidelines, out of the Federal Reserve, into the economy. So actually, open market operations has been the source of a little bit of controversy lately, okay, because just like there's a debate over fiscal policy, there are huge debates over monetary policy. Because we've gone through several rounds of what's called quantitative easing. Okay, quantitative easing is a fancy name for basically the Federal Reserve is buying a ton of government securities. Actually, the Federal Reserve is the single largest owner of government securities. In a sense, the Federal Reserve is the largest lender to the federal government of anybody, including China. Okay, they own far more government securities than China. And the point of all this quantitative easing, we have QE1, QE2, and now QE3, has been to try to increase the money supply, try to get businesses and people spending and hiring and get the economy rolling again. And a lot of people are suggesting, hey, this isn't working and it's just going to cause inflation in the long run. These debates can become especially fierce because it gets to some very fundamental political and economic philosophy questions. A lot of people don't like using monetary policy in the way that we've been using it because they'll say, creating prosperity by essentially printing money. They're not literally printing money. They're, injecting money into the economy through this quantitative easing is really fake prosperity, right? Just printing money isn't actually going to make people really more productive or richer. And there's, a big problem because they're not elected. So people think, hey, how much power are we putting in the hands of these unelected people? And for whom are they really acting? Maybe they're, acting more in the interests of Wall Street bankers than they are of the American people. The Tea Party really doesn't like these guys, really don't like the Federal Reserve. And in fact, Mitt Romney promised to replace Ben Bernanke as chairman of the Board of Governors in 2014 if he was elected president. So there you go. That's the Federal Reserve and how it works.